Hello guys, welcome back to my channel, and if you're a new subscriber, welcome. Thank you for subscribing. We just hit a milestone of 300 subscribers. Welcome. I have a lot of things in store for you. Let's get into this video, right? So I'll start by saying this is not a video you can skip. Watch till the end and you will definitely learn something. You will find answers to some of your questions and missing pieces to your puzzle, right? If you have questions at the end, after the video, you can ask me, in the comment section. I also have things for you to look into if you would like to execute like this. All right, so I'm going to play the recording and do a voice over it, right? So the algorithm, right, that books price and delivers price runs on specific macros that consists of time and price, right? That's how these charts print, as you can see. And if you're familiar with ICT's teachings, right, macros are a set of instructions that an algorithm follows. Or if you're familiar with computer science at all or programming languages, you would know what that is, right? And the algo follows this, and as a result you see price delivers to a certain level, right? And so those signatures, those things that the algorithm does, if you look into your charts, you can see them, right? If you look close enough, and it's just like fingerprints or footprints, you can literally follow it and have basically an idea of what's coming next, right? That's how you can predict the market. A lot of times you see people say, oh, don't predict the market, react to it. But it's like, if I'm trying to make profit from the market, I probably want to be buying the market low and try to predict how high it's going to go, and take some profits along the way, right? That's how you make money in this market. So you predict the market, or at least that's what I do. All right, so for this trade, right, I had a higher time frame PD array, right? The higher time frame discount array, and that's that dotted line you see, dashed line, is the midpoint of the daily week from the previous day's week, right? And when I saw the market structure shift right after this turtle swoop down here, the market structure shift breaking that's high, that was my confirmation that our price is about to start going higher. Basically, we're in a buy program. Okay, we're in a buy program. This is a market maker buy model. So we have the sell side delivery, and we're currently in the buy side of the curve, right? So when on the buy side of the curve, that's where I want to get my long orders in and get my positions in. So real quick, I'm going to talk about this, right? This order block here. I know you must have seen my tweet from probably a week or two ago, where I mentioned details and intricate details about an order block and how it works, right? Some things that are quite unspoken. Okay, so basically I said an order block must be created in order to bypass an opposing order block on the path of current order flow. In this case, current order flow is bullish, right? And this is a bearish order block, and what I was saying is, we should create a bullish order block in order to go through this bearish in order to go through this old bullish order block, right? So we need to see a down close candle, which is a change in state of delivery from buy side to sell side, right? From this buy program, we need to have a short-term sell program, which is this candle here, right? Then when price goes back higher above that opening price, we have a new change in state of delivery, and when price trades back down to it, I'll be expecting to see that be used as support, right, to send price higher. That's institutional accumulation, that's institutional sponsorship, right? And that's me doing it live and showing you that these are not just tweets and just tips for you to look at and skip, right? You need to back test and look into your charts and investigate these things. Are they true? And look for the times when they fail and ask questions. Then you will unlock new learning opportunities, right? You're going to unlock new learning opportunities. So how I see price, right, in the market maker model is like from point A to point B, right? How does price move, right? What's the narrative? Why does it do what it do? How is it going to do what it do? And point A in this case is my, the point of origin. The smart money referrals around point B is the draw on liquidity, and the draw on liquidity is the daily volume imbalance. Okay, the daily volume imbalance, that's what I was aiming for, and I'm going to show the trading view chart, and you can see my entry down there, right? That's where I entered, and price was trading higher, went through that order block, reclaimed the order block, and I said, well, there's going to be displacement at 1032, right? Let's see what happened at 1032. Well, at 1032, price ran lower with speed to do what? To run these stops, right? If there were trailing stops here, there was a turtle soup, right? And after the turtle soup, think accumulation, manipulation, distribution, right? Power of 3. So that was the accumulation phase. The manipulation phase is when price trades below that and reverts higher, right? So when it starts going higher, that's where the displacement comes in, right? That's where we see the speed that I was anticipating, basically speed, displacement, right? So you can time the markets, right? You can absolutely, determine when certain things are going to happen, when certain actions are going to take place, because the algorithm has instructions it has to follow. It has schedules and delivery times for price to get to certain levels. So in order for this to happen, right, there are actions that must be taken. There will either be price being held within a range or expansion, outside of a range and creating new ranges, right? So one other thing, right, is, well, here we have a, what do you call it? This is a measuring gap. Here is a breakaway gap, right? So a fair value gap that I didn't want to see filled. This is a measuring gap, and I'll show you how I use this measuring gap in projection of my target, right? And you also see me mark this time here, 10:55. That's about 10 minutes from now, right? So 10:55, I was anticipating the algorithm doing something. What do I mean by doing something? I mean, price could be doing anything at any time, but actually there are things that the algorithm is set to do at certain times. All right, there's nothing random. And you should always ask yourself, like, why it's doing certain things, and investigate by back testing, tape reading, and forward testing. Anyway, I anticipated that by 10:55, there should be a premium target met. Okay, there should be a premium target met, right? So basically, premium PDRA, and this right here, this dashed line, is the consequent encroachment of a 15-minute fair value gap, right? That's a midpoint of a 15-minute fair value gap, and that was basically my target. And you see, I took my first partial here, and after that, what really happened is, the algorithm just held price, and there was time distortion. So basically, price was not really allowed to move freely for a long period of time, and I wasn't going to just sit there and watch it, right? That's the perks, the advantage you get when you know what's likely to happen, right, at certain time. Because I don't think there's any point in just sitting down if the market is going to be stuck in a range of 2 handles, 2 points, for hours, right? That's pointless. I would rather go spend time and do something more valuable with my time, basically. Okay, so after I took my exit, I knew, this is not going to move probably until the PM session, and I just made sure, okay, I took my partial, I adjusted my stop, make sure I'm in profit. Whatever happens after that, it's nothing to worry about. It's a win-win, right? It's a risk-free trade. Okay, it's a risk-free trade. So I'm going to show you on TradingView what I was looking at, right? What I use for targeting and what concepts I actually apply in this trade. Okay. All right. Okay, so here's what my chart looked like. All right, I have multiple screens, and well, okay, so this is one chart, and well, so there's a matter of entry, there's a matter of trade management, there's a matter of risk management, position sizing, there's a matter of targeting also, right? Elements of a trade setup, right? Elements of trade management, risk management, right? That's what trading is. It's composed of all these things, and of course psychology. I mean, I would rather not hold through all of this, right? This was say the end product, right? Price was just being held here, and well, I'll explain that later. But anyways, so one of them, grading price swings, right? What's grading price swing? Is a concept taught by ICT, right? Basically starting from the origin of price delivery, from the low of a swing, of a price swing, to the high of the anticipated price swing, and that will be the terminus, right, where you expect price to reach for. That will be buy side liquidity right here, and further up here, that's the low, right? No, down here, that's the discount low of the daily volume imbalance, and here is the low of a daily candle, right? So between here and here, there's actually a void, a liquidity void, right, on the daily chart. I'm going to show you. There was a void right here. So you see that gap? So this is the low right above the 8:30 open today, and that's the low of, well, this volume imbalance. Okay, that's the volume imbalance measured from that body to this body, because there is no candle bodies in there, and the end result I would like to see is for price to print candle bodies within that range. Okay, within that range, and well, that's happening already, as you can see. So right here is the liquidity void, because there is no trading, there is no price in there, no wick, nothing. All right. Okay, this is still trading. All right, so all right, so back to this chart. I was saying, right, so grading price swing from origin to terminus, right, from beginning to the end, from point A to point B. I want to mark the 25% level, that's a quarter gradient. I want to mark the midpoint, that would be the equilibrium 50% level, and the 75% gradient level, and the final terminus, right? So, and well, here's what happened at 25%. I entered right around excuse me, I entered right around there. As price hit that and traded lower, that's where my entry was, as you could see in the video. Traded higher, we see that consolidation around 50% around equilibrium, traded higher, price was held here, traded back down, accumulation, manipulation, back to equilibrium, run sell stops, trade higher, create a new dollar range, trade back to discount, Now trade higher, 75% gradient, and continue higher to terminus, right? So these are things you can use to, track if you're on site, basically, right? On site with the algorithm, on site with your trade. And also I used swing projections, right? I used the swing projections, and I'm going to show you. All right, so here's the 1 minute chart. Here's the 1 minute chart. And this low to this high, right? The low that, the last swing high before running the last swing low, right? I projected the higher, standard deviation of 4. Look how perfect that is, and price reacted to that. Then standard deviation 5 lined up perfectly with 15-minute order block, right? And I had the measuring gap. Hold up, I'm going to show you the measuring gap on the 5 minute, and you'll see how it lines up. All right, so the measuring gap, right, is here is a breakaway gap. All right, what's a breakaway gap? A breakaway gap is usually either the first or the second gap that forms in a discount level on the buy program, right? If you have a market maker buy model and prices in the buy program, usually the first or second fair value gap that you see, right, that doesn't get filled, that's a breakaway gap, right? It means the algorithm is, in a hurry to price somewhere, right, to deliver somewhere, and in this case, right, buy side delivery. Okay, so that's the first gap, and here's the second one, right? Here's another fair value gap. Okay, and we have institutional order flow entry drill because that gap was also left open, so price just traded down to the very low of that candle. That's 46,730.25. the low of this candle, 46,730.25, right? Institutional order flow entry drill. And so for the measuring gap, I have this fib from the low, the swing low, to the premium high of that fair value gap. Okay, that's the measuring gap. That fair value gap is the measuring gap. Okay, and where does that take us? It takes us to 4684.5, and that lines up perfectly with that 1 minute swing projection of -5 standard deviation. And look at this high right here, 4684.50. That's perfection. All right, and well, this high right here is just me denoting the range high, right? The daily range high that price was held in, for an hour of time distortion, and that's the daily range low for that. And when time macros come into play, right, from 11 a.m. to 12 a.m., right, it was being held, and at 12, which is the lunch hour, price creates a low, runs sell stops, trades higher, creates that daily range, trade down into discounts, bullish order block, and now it's ready to release for, well, the PM session, right? 1:30, creates this fair value gap, trades lower into it, 120, and higher it goes. Right? So I'll go back to the video. So that's the trade breakdown, and those are the components I use. Those are the concepts I use in the video. Right? If you have questions, let me know in the comments. Just know nothing is random, and if you have, I know a lot of people like always ask, about time. Do you have any, sauce or any, secrets or whatever? My advice is to start with kill zones, for intraday trading. Then use ICT data ranges for like short term and swing trading. And of course, you might get stuck in trade sometimes, but that's fine. But you can eliminate it, as time goes by, you get more experience. Also be careful you listen to, there's people spreading misinformation about how things work in the market. And you've seen me prove it today, right? These concepts, the things I talk about on Twitter, on social media, I have, proof. It's things that I've been studying for the past, 4 or 5 years. So I know what I'm talking about, and it's really, me sharing my experience with you, and, giving you things you can go study and things that can improve on your trading yourself, right? So, if you've been following me for a long time, you know how I time the markets consistently, and my executions always look the same, right? That's something you can note, right? It always based on the same framework, right? The market maker models, and definitely ICT concepts, and ICT, right? So every week, every single day, it's the same thing, right? It may not be 100% the same, but it's the same framework. And if you study these things, you can do it too. If you just put time into it, put your energy into it, and put the effort in. These are things that can be achieved, if you are trained by ICT. So once again, it's the Alter Ego Trader here. I hope you enjoyed the video and found more clarity. I'll be answering your questions in the comments. You can also reach me on Twitter and Telegram. Thank you for watching.